Hello folks, this is Rich Prout from Stonehearth Capital Management with a March 2016 Educational Economic Update. In this video, we'll talk about some of the economic headlines that influence markets in the last month and give you some insight into what they could mean for you as an investor. Please stay tuned at the end for a required disclosure statement. January was rocky for stocks, and February didn't offer investors any relief. Volatility was still the name of the game. However, we did get some positive news. Let's talk about some of the month's major headlines. If you've been watching the news, you've probably heard a lot of talk about a possible recession. Is a recession coming? Some economists are worried about a U.S. recession because of issues like low oil and commodity prices, emerging market problems in countries like China, and fears that central banks are out of tools to fight economic trouble. These fears are not baseless. However, they don't necessarily spell recession. There are also a lot of positives to consider. One indicator that argues against a coming U.S. recession is the labor market. The January jobs report showed that the economy gained 151,000 jobs that month. The gains pushed the headline unemployment rate down to 4.9%, the lowest it has been since February 2008. Another positive is that wages are growing and Americans are continuing to spend money, which is a good sign for the economy. In short, we don't know if a recession is coming, and neither does anyone else, regardless of what they say on TV. Recessions don't just happen for no reason. But we are taking concerns seriously and watching fundamentals carefully. Plummeting crude oil prices have had a lot to do with negative sentiment in recent months. Crude oil prices are so low because the world is awash in it, and the excessive supply combined with slowing demand from China is pushing down prices. Investors worry that persistently low prices mean that the global economic growth situation is growing worse. Low prices also cut into energy company profits, as well as those of companies with stakes in the energy industry. With 87% of the S&P 500 companies reporting in, we see that overall S&P 500 earnings were down 3.6% in the fourth quarter of 2015. However, if we remove the energy sector from analysis, earnings actually grew a healthy 2.5%, and firms that mostly depended on U.S. demand did even better. The overall economic picture wasn't as bad as expected last quarter. The second estimate of quarter four economic growth showed that gross domestic product grew at 1%, not the 0.7% originally estimated. While economic growth decelerated in the last 3 months of the year, it didn't slow down as much as economists thought. Responding to concerns about economic growth, the Federal Reserve declined to raise interest rates again in its January meeting, keeping them low to help investor confidence. While the Open Market Committee will meet again in March, most economists don't think the Fed will hike rates again until June, at the earliest. Bottom line, 2016 has been a rocky road for investors, and the volatility is likely to last for a while. While corrections and uncertainty aren't easy, let's remember that they are coming after years of solid equity growth. We're keeping a close eye on fundamentals and helping our clients make informed decisions based on the latest research. Once again, this is Rich Prout with Stonehearth Capital Management signing off for the month of March 2016. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 978-624-3000. We'd be happy to speak with you. Thank you.